Two people start with $100,000. One buys a rental property. One invests in a dividend stock portfolio. 20 years later, who has more money? The answer changes depending on which numbers you use, and most of the numbers floating around the internet are cherry-picked. Today we use real numbers, real costs, and a real comparison that accounts for everything both sides conveniently leave out. Let's set the scenario. Person A buys a rental property in a mid-sized American city. Purchase price, $250,000. Down payment, $50,000, 20%. They finance the remaining $200,000 at a 7% mortgage rate over 30 years. Monthly payment, $1,330. They rent it out for $2,000 per month, a common benchmark in many markets for a 3-bedroom property in a non-coastal city. On paper, that looks like $670 per month of cash flow. Let's run what it actually looks like. Property taxes in most U.S. markets run 1 to 1.5% of value annually. On a $250,000 property, that's $2,500 to $3,750 per year, roughly $208 to $312 per month. Insurance on a rental property, approximately $1,200 to $1,800 per year, or $100 to $150 per month. Maintenance and repairs. The standard rule of thumb is 1 to 2% of property value per year, or $2,500 to $5,000 annually. Vacancy. Even a great landlord will average 1 to 2 months of vacancy per year. That's $2,000 to $4,000 in lost rent. Run the real numbers. Gross rent, $24,000 per year. Mortgage, $15,960 per year. Property taxes, $3,000 per year. Insurance, $1,500 per year. Maintenance, $3,750 per year. Vacancy, $3,000 per year. Total expenses, $27,210. That's a net loss of $3,210 per year, $267 per month. Before any major repairs, capital expenses, new roof, HVAC appliances, or property management fees if you hire help. And if you hire a property manager, which eliminates the personal time cost but adds 8 to 10% of rents annually, that's another $2,000 per year, pushing the annual loss to over $5,200. Many landlords convince themselves they'll self-manage to avoid this fee. In reality, most end up hiring help once 2 a.m. maintenance calls start cutting into their sleep, or they realize the tenant issues require someone trained to handle them. This is not unusual. In most American markets at current prices and interest rates, the cash flow math on rental real estate is negative or barely break even. Real estate investors who bought before 2020 at lower prices and lower rates are cash flowing positively. Buyers entering the market today are often not. So where does real estate's wealth building case come from? Appreciation and leverage. The property that costs $250,000 today might be worth $450,000 in 20 years. Historical U.S. real estate appreciation averages 3 to 4% annually, varying dramatically by region. On a $50,000 down payment, that's a $200,000 gain, a 400% return on invested capital. This is where leverage magnifies real estate returns so dramatically. You controlled a $250,000 asset with only $50,000 of your own money. Additionally, your tenant is paying down your mortgage for you. After 20 years of tenant payments, your loan balance drops from $200,000 to approximately $30,000. That's $170,000 in principal paid down entirely by someone else's rent checks, building equity that's independent of any appreciation. The full real estate return calculation. Equity from appreciation, plus $200,000, conservative 3.2% annual average. Equity from mortgage paydown, approximately plus $170,000, net rental losses over 20 years, minus $64,200, at $267 per month. Transaction cost to sell, realtor fees 5.5%, minus $24,750. Total estimated net gain, approximately plus $281,050. On a $50,000 initial investment, that's an approximate annual return of 7.5 to 8%. Before accounting for your time managing the property, the stress of difficult tenants, the illiquidity if you need to exit the market, and the concentration risk of having most of your wealth in a single property in a single market. Now run the best-case real estate scenario, because the bears of this debate always use the conservative number. What if the property appreciates at 6% annually instead of 3.2%? The $250,000 property at 6% compounding becomes approximately $802,000 after 20 years. Equity from appreciation alone, $552,000. Add in the mortgage paydown of $170,000 and subtract the rental losses and transaction costs, and you're looking at a total net gain approaching $640,000 on a $50,000 investment. That's the number real estate investors in Austin, Phoenix, South Florida, and coastal metros who bought between 2010 and 2020 actually experienced. A $50,000 down payment in Austin in 2015 on a $250,000 property that appreciated at or above 6% annually, completely plausible for that market over that window, produced extraordinary wealth. The brutal honesty: nobody could reliably predict in 2015 that Austin would appreciate at 6% annually, and not, say, 2% like the national average suggests. Real estate investors who got rich in the last decade didn't make better decisions. They made the right bet in the right zip code at the right time. The investors who bought in markets that appreciated at 1% annually made the exact same logic, the exact same effort, and got a fraction of the result. The leverage amplifies both the wins and the geographic randomness. There's a cost hiding inside the real estate calculation that almost nobody runs: time. Studies estimate that self-managing landlords spend an average of 5 to 7 hours per month per property managing leases, handling maintenance coordination, screening tenants, responding to requests, and dealing with vacancies. That's 60 to 84 hours per year. If your time is worth $50 per hour, a conservative estimate for anyone with meaningful professional skills, that's $3,000 to $4,200 per year in time cost that never appears on any real estate return calculator. Over 20 years, the time cost alone is $60,000 to $84,000. If you apply the opportunity cost and ask what that 60 to 84 hours per year could have produced in your career, consulting work, or professional development, the real cost is potentially much higher. Dividend investors spend approximately 30 minutes per year reviewing their portfolio. The compounding difference in time allocation over 2 decades is substantial, and it never appears in the side-by-side spreadsheet. Then there's the scaling problem, which is the most practical argument in this entire comparison for most people actually trying to build wealth. Dividend stocks scale infinitely from any starting point. You can invest $100 per month and it compounds identically on a percentage basis to a $100,000 lump sum. Every dollar added works at the same rate. The person with $200 to invest this month has full access to the dividend compounding machine. Real estate doesn't work this way. You need $50,000 for a down payment on a $250,000 property. You can't buy 1/4 of a rental property. You can't add $200 per month to your real estate position and watch it compound. Until you have enough equity or savings for another full down payment, you're stuck at one property with one tenant in one market. For the majority of Americans who are building wealth incrementally, contributing a few $100s per month from a salary, dividend stocks offer complete optionality and real estate offers nothing until the down payment threshold is crossed. This accessibility gap is why the wealth-building population that actually follows through with a 20-year plan skews heavily toward dividend and index investing, while real estate strategy tends to favor people who already have significant capital to deploy. Now let's run Person B. Person B invests $50,000 in a dividend-focused portfolio, 60% SHD, a fund tracking dividend-paying companies, 40% realty income and similar dividend payers. Average blended yield, 5%. Average blended annual total return, dividend plus appreciation combined, 11%. Here's the power of that 11% return over 20 years. If Person B reinvests all dividends automatically, which means every dividend payment immediately buys more shares, which generate more dividends next month, the math compounds dramatically. After 20 years of reinvesting all dividends at 11% annual return, $50,000 at 11% annual return, compounded equals approximately $380,000 to $420,000, depending on the specific mix. That's $400,000 in liquid, diversified assets spread across dozens or hundreds of holdings. No tenants, no maintenance calls, no property taxes, no repairs. The portfolio generates approximately $20,000 per year in dividend income at a 5% yield. You can sell any portion at any time. If you need cash tomorrow, you sell a position and have it in your account in 3 days. And here's the tax difference. If this is in a Roth IRA, all $400,000 and every dollar of that $20,000 annual income is tax-free. If it's in a taxable account, dividend income is taxed at lower long-term capital gains rates, 0%, 15%, or 20% depending on your income bracket, significantly better than the ordinary income rates on rental property depreciation recapture. On paper, person B wins, dramatically. But here's where the real estate side pushes back. And the pushback is legitimate. Person A used leverage. If they'd put the same $50,000 into dividend stocks and also somehow obtained a $200,000 loan to invest in dividend stocks at 7%, simulating the leveraged nature of real estate, the comparison would be dramatically different. Real estate bulls will correctly point out that no bank will give you a $200,000 loan to invest in dividend stocks at 7%. Banks will only lend money for real estate at those rates because the property serves as collateral. The leverage is a feature unique to real estate, and it meaningfully amplifies returns when appreciation is happening. Person B's portfolio also carries stock market volatility. In 2022, SHD fell 26%. A dividend investor who panicked and sold in 2022 realized significant losses and missed the subsequent 24% recovery in 2023. That's a behavioral mistake that costs decades. Real estate, being illiquid, doesn't give you the option to panic sell. You can't liquidate a $250,000 property in 3 days when the market drops. This immobility prevents behavioral mistakes, but it also means you can't respond to genuine opportunities. During the 2008 financial crisis, real estate investors couldn't sell. They had to hold through foreclosure risk. Stock investors could have sold anything, taken the loss, and repositioned. That flexibility is valuable in severe downturns. The truth is more nuanced. Real estate's illiquidity can protect you from your worst instincts, but stock market liquidity gives you options you might actually need in a genuine emergency. So what does the real comparison tell us? For total wealth accumulation with no additional work, dividend stocks and index funds typically produce higher returns on invested capital than rental real estate in today's market conditions, especially for first-time investors who haven't yet found underpriced properties. For building wealth using other people's money, specifically bank leverage, real estate's unique ability to borrow at fixed rates and let appreciation and tenant income service the debt creates wealth that's difficult to replicate in public markets. For cash flow today, in most markets, neither strategy cash flows reliably in year one. Real estate with leverage may run slightly negative while dividend stocks generate 4 to 5% income but with 100% capital at work, rather than leveraged 4 to 1. For passive income, dividend stocks win decisively. You receive income without calling plumbers, managing lease renewals, or handling 2 a.m. maintenance emergencies. For tax advantages, both have meaningful benefits. Real estate offers depreciation deductions, 1031 exchanges for tax-deferred growth, and step-up in basis at death. Dividend stocks and Roth IRAs grow and generate income entirely tax-free. The honest answer most financial content refuses to give. It depends heavily on your market, your timeline, your skills, your temperament, and the price at which you can acquire assets. If you're in a market where properties are priced to cash flow, where rent-to-purchase ratios still make sense, real estate with leverage is a wealth-building accelerator that's hard to match. If you're in a coastal city where buying a $900,000 starter home makes the math permanently negative, dividend stocks are almost certainly a better path. The people who win over 30 years almost always hold both. Real estate for leverage, appreciation, and tax-deferred growth through 1031 exchanges. Dividend stocks for liquidity, passive income, and compounding without management friction or concentration risk. But here's the ordering most millionaires follow. They build their dividend stock portfolio first. It's passive, it requires minimal capital to start, and it scales infinitely. Once they've got $150,000 to $300,000 in dividend stocks generating reliable income, they deploy capital into real estate. By then they have cash flow to handle negative cash on a property. They have liquidity if the market crashes, and they're not putting their entire net worth into a single illiquid asset. The question isn't which one is better, it's which one makes sense for your situation right now. If you're starting from zero with $50,000, dividend stocks will very likely produce higher returns with less time and stress. If you're already wealthy with diversified stock holdings, and you've found an underpriced property in a cash-flowing market, real estate leverage can turbocharge the second phase of your wealth building. What do you own or plan to own? Drop it in the comments. Real estate investor, stock investor, or building toward both? Subscribe. Next week, we're going into the 12 things wealthy people quietly refuse to spend money on, and some of them will genuinely surprise you. Hit like if this gave you a clearer picture than the real estate versus stocks debate usually does.